I trained to be a lawyer, and all my growing up, I thought that that's the only thing I wanted to be. And the funny thing was that on the day I graduated, the weight was lifted off the back of my, head, and that's the one thing I didn't want to be. So it was one of those. My parents were civil servants. My father was a railwayman. My mother was she was a clerk in the university, and stuff like that. And they were good, pretty decent Christian, middle class, and government servant type of people. So there was nothing in my upbringing that suggested that I was going to be entrepreneurial. And so after I qualified as a lawyer, I spent 10 years not being a lawyer. I decided to go out and look for things to do. So I was in consulting a lot. And towards the end of those 10 years, in those days, if you're from any one country, you tend to work in that country, especially if you come from my part of the world, Southeast Asia, where, I finished college in Singapore, and then Singapore is a very small little island surrounded by various countries. Today, if you graduate from university, you'd be out of your country and doing projects cross border within 3 weeks of graduation. And in my time, for 5 years, I sat in the same office in the consulting company and serving, clients, large corporates and stuff like that. So I wanted to go out and, do things. And then I got a couple of other jobs that made me travel a lot more, clients in Indonesia. And these were during a period when corporates in emerging markets were raising capital. And it was exciting to see how the capital market itself was being formed in many of the countries that I served. And then I said, you know what? I'm not the kind that can climb the corporate ladder. So what I did was I invented a business for myself. And the simple story was that the Asian Banker started as a publication, which gave me an excuse to go out there, meet the chairman of banks of any of the large countries around me, and they're excited to tell their story. And from there, I recreated the consulting business, the research data business, and so we are a full-fledged financial services industry research consulting company. And then we have several, different things. And why banking and finance? I think in the time that I went out to market, the nice thing would have been to do government or big business, but big business didn't really exist at that time in a lot of Asia. And government was too dangerous. You go to jail for saying things that governments don't like. So I call banking the cathedral industry. In other words, if you land in any country, this is the industry that sits in the center of the city. It covers everybody's life from cradle to grave, and it gives you a front seat view of the country's economy. And in that time, so I started my business in 1986. 1996. Sorry, 1986 was when I graduated. So there was a 10-year journey from there to starting the Asian Banker. And by 2000, I had found my way into China. And the chairman of the largest bank, ICBC, came to Singapore. And by 2000, the Asian Banker was quite well known already in about 3 or 4 years. And the chairman of the largest bank came to Singapore, insisted on having lunch with me, and I had no clue why he did that. And then I was later to find out that that was part of the preparation that these Chinese banks were going through to prepare for their own gigantic IPOs, which in the case of ICBC, the world's largest banking IPO at $20 billion 4 years later. And ever since, I've had a front seat view of this huge country's development to what it is today. And of course, and the other thing is this, that because I was called the Asian Banker, any American, personalities, and I can name drop for you if you, I mean, and to tell you who they are. But the point is that chairmen of bank, when they would come to Asia, would look me up, and I would have their personal attention for 3 weeks as they travel around the region, and we use them to have conversations with the banks in Asia and so on. And so, in a very strange way, I also became, associated or acquainted with some of the very very interesting people. Like my book, for example, the foreword is written by Barney Frank, who wrote the Dodd-Frank Act. So in that way, a whole range of people, around the world. So and in from from the backwaters of Southeast Asia to become a global player from there on. It's been an amazing journey that way.
Yeah, that does sound like a heck of a journey. If it's like, let's kind of take one step at a time. It's 1996. You've come out with this publication. For those listening, like to me, especially thinking in those shoes, like, okay, it's 1996. Like you're coming out with a publication. Is this like a physical book that's coming out periodically? Is it like a newsletter? And then how does that turn into an actual business from that standpoint?
Well, it was at that time a magazine, and it was mostly physical. The first few weeks you got to print it all yourself, and I started with 2 employees. Today I have 70 full-time employees, and then 20 part timers and freelancers that I use in different parts of the world. So you started off that way, and then this interesting thing is when you call your magazine The Asian Banker, within the second day, we had an intern, a very young girl, sitting in the office and calling the banks to take on a subscription and all that. And one banker said, "Oh yes, yes, the Asian Banker," because it sounded so pompous. They thought they'd heard it before, but we were like the third or fourth day in business. So choosing a right name also matters. And then, of course, you walk the walk and talk the, I mean, and walk the talk as well, which is, integrity is very important. Putting together data that the industry finds useful. So for the first time ever, bankers in Asia were able to see their numbers next to each other. So, for example, ATM penetration, we would publish that and say ATM per million population. This is what the ratios look like in all of the different countries. At that time, the US is something like 250 ATMs per million population. And then, some countries in Asia would have like 60 ATMs per million population. And then when you look at the cities, they are like 250 ATMs. So, and when you fly into the city, you would actually see that all the ATMs are in the city, that kind of thing. So we were able to tell stories of how the banking industry was configured in all the different countries, and then by comparing what needs to be done. And of course, the US always presented itself as a benchmark, meaning that if you're a mature banking system, this is what you look like. And that was in those days. Today, it's totally different because there are banks in Asian countries which are incredibly superior, and they've gone further down the road and all that. So basically, let the numbers do the tell the story.
So I have a lot of questions. There's a lot of things we can dive into, but first I just want to put a definition out there. It's actually the name of your book. It's The Great Transition. And one of the reasons Justin and I were so excited to have you on is I think we do a really good job. I'm going to pat ourselves in the back with the micro. We talk about, how to earn more, how to save more, how to invest, but we don't typically cover macro stuff. Not even, I mean, you're global macro. We don't even cover macro US stuff that much. So just laying the land here, I definitely want to cover a bunch of macro stuff, US, global, and how people can use that to then kind of convert that into micro habits or just decisions, actions they can take in the micro. But yeah, going back to my first question, can you just define what the great transition is? What do you mean by that?
So after 20 something years in covering banking, and then covering it from the perspective of the practitioner, and then deciding for myself that I wanted to write a definitive book that talks about where this industry is going, I had to sort of step outside the traditional industry that the practitioners were comfortable with and start saying to myself, how is this industry going to be deconstructed, and how is it going to, break through into, the new technologies that are coming on stream. And of course, you had the creation of, the creation of Bitcoin, for example, in 2008. Now, how does that, honestly affect banking as we know it? So it was a personal journey also in trying to stand outside the industry, because if you're part of the industry, you'll be too comfortable with what everybody else is doing, and bankers are very good at talking about digital as if it is the industrialization of finance instead of the digitization of finance. It's a big difference. Industrialization of finance means banking with a view of reducing your costs, increasing your service levels, and doing it as automated as possible, but doing the same thing, again and again into the digital world. So nothing changes as a result. But decentralized finance and so on brings the promise of new models by which the financial services industry should function. And at the core of that promise is the disintegration of the intermediation business. In other words, you and I, Cody, if we wanted to send money to each other, increasingly we do not need an intermediary. So the traditional banking industry has to figure out a new role for themselves as we make this transition. And I call it the great transition because if finance can be highly personalized, society will become highly personalized. So, and you're right, it's a big book. It's a huge themes, not just about the banking industry, but of how we will live our ordinary lives in the future, and also how assets will be, will be perceived, values, and so on. And so I've thrown in a lot of stuff into the book, but I've always gone back to first principles to try and figure out what is this journey that the industry is making from its traditional physical moorings to digital. Now, the nice thing about banking is there are lots of features about banking, the DNA of banking, which holds it together that we don't appreciate. For example, the deposit business, right? The deposit business in the old days, in the traditional days, was a beautiful business, which if a bank gets it right, in other words, you get you build a bank over a long period of time. You build trust with your customer base. You have good branch networks, and your branch networks are close to your customers. You are rewarded with the lowest cost of funding to run your business. And you go to any country in the world, the largest, oldest banks have the lowest cost of funding. And they also tend to be the most profitable banks in those countries. And the reason they are profitable, and deposit on the bank's balance sheet is actually a liability. The bank owes the customer the money, right? And the asset on the bank's balance sheet is the loan. So you think that it's the asset that generates revenue. But in banking, it's actually the liabilities that generates the revenue. If you keep your costs as low as possible, the margin is what you make your money from. The lending is the easy part, like you send it out there. But if your cost of funds is too low, you will blow up on the lending business. So you really need to get the deposit side right. And so, when we do an evaluation of a bank's business, we look at its ability to garner cheap deposits. Now, then we take it into the digital realm, and how's that changed today? That you and I and the next generation, can actually put their deposit into any, digital wallet if they wanted to, and by that the banking industry is losing its hold on customers to be able to garner cheap deposits. And so there are lots of neobanks, there's PayPal, the payment platforms, all of it which are deposit-taking institutions. So how's that relationship that used to define banking? How's that changing into the new realm? So that's what I mean by the great transition, which is there's a great transition taking place at a social level, but also within the industry. So the thing is that where it's taking us requires us to appreciate where we are coming from, and then understand how the rules are changing. So in the old days, the deposit business, the name of the game in the deposit business, and your older listeners would appreciate this, was in the interest that the bank gave for your deposit, and compounded interest was a powerful savings tool. But today banks don't give good interest rates, right? I mean, the interest that you get on your deposit is so pathetic that just going to the ATM to withdraw money makes you lose money on the taxi fare. It's really, you can't become rich with bank deposits. In fact, you need to invest in structured products and all kinds of investment products in order to generate wealth. And what the industry has not come to terms with is that the deposit business has moved from savings to utilization. The utility of the deposit is what defines the industry. And utility is not just people, going out to the ATM and withdrawing money so that they can go out and have a meal, but when deposits are digital, you're able to function in a whole range of digital situations. Everything from paying your friend instantly, like you're going to have FedNow coming on stream in the next few weeks, to being able to pay on tokens in a game, to being able to buy an NFT in the metaverse. So for all those reasons, it's very important that a financial institution today is digital, and in order to serve the utility of the deposits business in the virtual world or in the digital world. So that's the kind of transitions that I'm talking about.
And I have no doubt that we'll dig into some more of those type topics, some of the like the cryptocurrency type topics. But you mentioned one thing there. We're talking about like building trust and the deposits, and it made me think about here. It wasn't that long ago, but although it seems like the news cycle has already started covering up, we started having some banks fail with like First Republic Bank. Do you think that was a macro instance of a poorly run bank, or was that more of a macro problem that we should all be looking out for and a sign of things to come?
Actually, I gave you the deposit example for precisely that reason, because that's the story of Silicon Valley Bank, Signature Bank, and by the way, I've visited Silicon Valley twice. I know the chief executive of Signature Bank, and then of course you have First Republic and so on. And technically, these banks did what all banks do when they have excess deposits, that is to dump them into treasury bonds as a revenue yielding asset. It was a no-brainer. That's what banks have always done. In fact, going back to the old days, there used to be a lovely bank, bank share, Commerce Bank share, bank share, right? And it was run by someone called Vernon Hill, and he was one of the cheapest, best deposit gatherer of any bank in the U.S. And he didn't even bother building a lending business. All he did was put all of the deposits into treasury bonds. And it yielded him all the revenue you wanted. So the banks were not doing anything other than what they always have been doing. And you would imagine that treasury bonds are the safest possible asset class to deploy excess deposits. But what I'm trying to persuade the banking industry and also regulators is that the name of the game has changed in the deposit business. So for the banks that failed, Silicon Valley and Signature and so on, especially Silicon Valley, actually Signature was I think was a regulatory problem in there. Now the thing was Signature Bank. Everyone now says that, you know what, on a Sunday afternoon, just when Peter Thiel tweeted, take your money out, in one afternoon, $80 billion just got withdrawn, and that's the power of digital banking. But that's only step one. The whole power of digital banking goes far deeper than that, and it's taking us on a journey, okay, a great transition to a whole new world where the deposit business needs to be understood differently. Okay, and this is something that I'm trying to be a voice to tell the industry that you really need to think differently about the deposit business going forward. Now, bringing in the new disciplines that crypto is creating, when a bank takes your deposit and puts it into an account, the whole technology of the bank is so archaic that the mainframe in the bank processes the information that it has your deposit in its account on a batch processing system. In other words, even when the bank is able to give you your money when you want it, it can only consolidate its positions overnight every day. So it's not a 24/7 business. Then you juxtapose what's happening in crypto. Crypto is a 24/7 industry managed by nobody, and having all the liquidity in the network, and then the algorithms to create applications around them. So crypto is actually setting the standards for traditional banks. This is what you need to measure up to in the digital world, and you're not measuring up to it right now. And so if you take Silicon Valley Bank again, for one whole year, they had problems trying to match their assets and liabilities. They were getting incredible amounts of assets, liabilities, that means deposits, and they really couldn't figure out how to deploy that. And their problems were accumulating over time. But when you see what's happening in crypto, all of these issues are actually managed on the back of an algorithm. So I'm saying to bank treasurers, look at what's happening in crypto and in decentralized finance. There are some new disciplines that can backtrack back into traditional banking.
I think it's really interesting what you said about like the Peter Thiel tweeting out and all of a sudden like 80 billion in withdrawals. And something that you talk about is the next financial crisis and why it's going to basically be a derivative of like public perception and digital miscommunication. Could you kind of explain a little bit more what you mean by that?
So, and you see, when I need to explain something like this, I need to explain it in two forms. One is
Okay.
for the lay person, that means a non-banker, and how he sees money, and the other is for the bankers to see how their industry had changed substantially right in front of their own eyes. So to the bankers, I will say this: that look at how the banking regulatory regime has evolved since after Bretton Woods, right? So Bretton Woods was the end of Bretton Woods was 1971, right? Nixon goes on TV and tells the world that, you know what, the U.S. will not hold to the dollar anymore, dollars to the price of gold anymore, right? But it took 12 years for the first full crisis to be to be fully mature, which is the savings and loans crisis. And what was the savings and loans crisis? It was actual mortgages set on the books of the mom and pop banks, the savings and loan institutions, and they were finding it difficult to match the two. And what came out of that was Basel One, which is the first regulatory regime created to make sure that banks have enough liquidity in their balance sheet to meet demands and so on, right? And Basel One's solution was very simple: was 8% capital adequacy ratio. Then by the time Basel II came on stream, banks' balance sheets have started changing. They started having securities on their balance sheet. They started having ephemeral assets like a derivative of a mortgage. By the time you get to 2008, you had derivatives of derivatives, futures, which were traded among the New York banks rather than the Main Street banks. So an entire industry had been created where there can be a bank run based on the the trade of traders rather than on the actual balance sheet of the banks. And so this is where I'm taking it. And today we are in a position where there can be a bank run on the back of a tweet. And by the time you reach to where we are today, the cost of a bank run and the cost of a banking crisis is increasingly ephemeral. In other words, it's got nothing to do with the balance sheet of the bank or the banking industry. It's got to do with perception. And the assets themselves are ephemeral. So we need to start thinking of the industry very differently. So Basel II, for example, started to tell banks that you needed to have three pillars. The market pillar, the operations pillar, and the asset liability pillar. Then the Basel III started telling banks that, you know what, we don't know what you actually have on your balance sheet, so you need to do an internal rating to try and qualify the assets and mark to market value of your assets. In other words, the regulators are telling banks that you got to help us with this one because we don't know how to value the assets that you have in your book. So can you imagine what Basel IV will look like when it eventually comes to stream? That all of us are being affected by perception and also by the network effect. So we are becoming more networked even as the industry is becoming more digital. And so that those are factors that changes how the industry operates and where the risks will come from.
And with all this information kind of like setting the stage of what's going on in finance, what should listeners be thinking about for their own personal lives? Like, what should someone armed with that information, what kind of different decisions would you make, about the future of their money as an individual?
So two things. One is your relationship with your institution. I think that many of your ultra high net worths already know this, which is they are becoming increasingly self-directed in their investments, in their financial decisions, and there is greater what you call symmetry of information between the user of finance and the provider of finance. And so the providers of finance, especially in wealth, they are scrambling over themselves to remain relevant to the customer. It's like Uber, right? You now know where the cab is, how many cabs there are out there, and what is the average price that they are bidding to take you on as a passenger, right? So you have almost as much information as the cab industry and as the regulators have. So finance is becoming that way. That the individual has got greater access to information. Now, to the industry, it also means that the empire can strike back, which is what happened 2 years ago in the meme stock, crisis, the Reddit revolution, GameStop, and so on, right? Where you can actually have retail customers banding together to push back on, or they thought that they were pushing back on shorters on the hedge fund, on the hedge fund side of the game, and we will see increasingly the ability of ordinary people to respond to financial opportunities or crisis, and they are a factor to be taken into account. So the nature of the relationship with financial institutions has changed dramatically, and for certain things like insurance, for example, the banks still think that they can get away with selling investment-linked products, for example. And you know something? Every bank CEO I know personally will never buy an investment-linked product, although the banks sell them. Okay, because that's the stupidest thing to do. The cost of the product is too expensive for the customer, and all it does is it just rewards the distribution network in the banking system. So ordinary people are becoming aware of the inefficiencies of financial intermediation and the alternatives that they have to manage their own assets. The second thing is that the nature of assets are also changing. We live in a world today where the best asset that you can buy if you're building wealth is a property. And property means a mortgage that you sign on that is between 7 years and 30 years of paying back. And hopefully in that period of time, you generate wealth. But think of what a mortgage will look like when mortgage registries are digitized, where encumbrances and liens and and whatever claims there are on properties are totally digitized, and where property can be bought and flipped, on the strength of an app on your phone by a millennial or a Gen X or a Gen Z or a Gen A. Okay, how do you think they will treat assets like property? And the whole thinking of fixed assets and wealth is going to be changing dramatically.
So, with all this being said, and the, I guess, higher risk of like a run on the bank from a tweet and things like that, do you recommend people kind of spread their assets out amongst different financial institutions, whether that's their banks, whether that's their like investment accounts? And if so, how do you then determine like, okay, this is one that I can trust. This is one that I can put like a decent amount of my net worth into?
So something I say towards the end of my book, and I actually borrowed this idea from a Rand Corporation analyst. He said that society moves from one phase to another, and there are four phases. It used to be tribal, and then it became institutionalized, and from institutionalized we created markets, and from markets we will become networked. And he wrote this paper in 1992 or 3 or 4, something around that time when the fax machine was the most developed technology around. Um, you know, and and what when I applied his thinking, he wasn't even talking about finance, he was talking about the technology itself. But when I applied it to finance, I said, oh my goodness, yes, we are in the markets phase of human development, and we are about to move into the network phase. So when you take something like crypto, and you see all the arguments that are taking place in crypto right now. So what I say is this: that everything that Charlie Munger and Warren Buffett say about crypto today as a markets instrument, they are right. They're not wrong. Okay, they are good. You need it needs to have an underlining utility. You need to assess it on that basis. And if it's a security, then it's a willing buyer, willing seller situation. In other words, you must maximize your profit at the point of transaction, and then it's done. But when we move into the network phase, it generates new rules by which assets are valued, and wealth the source of your wealth is valued. The network itself is a generator of wealth. Okay, and that is something that a lot of people just can't imagine at the moment. But the simplest example I give is information. Like if I sold you a house or a security, a share, at the point of selling it, I have to maximize my profit, and the deal is done. And then there's a winner or a loser, and there's no going back on that. But when you think about information, it's the one asset which if I give to you, I don't lose it. And I need to give it to 100 people. When I give it to 100 people, I become more powerful as a result, right? So think of it that way, that in the network world, assets increase in value when it travels through the network. And so then we start thinking, what assets are going to be in that way? We already have the seeds of such assets in gaming, okay, the tokens created in gaming, in NFTs, the way in which people are willing to, provide a value. Now, these are early days for these technologies. So some of the developments will suddenly disappear because they didn't make any sense, but it is maturing step by step. Into a whole new idea of how wealth is created. Now, then the question is, how do I then, what sort of portfolio should I have? I think that you need to have a combination and then write the transition as it happens, and we will figure it out as we go along. But these are still early days in that way.
So we've talked about, one of the really big, I guess, kind of like hype type things is, cryptocurrencies all over the news. And now, AI is kind of everything everybody's talking about, artificial intelligence. When we're looking at banking, how do you think that artificial intelligence is going to really change the way we think of banking and finance today?
Walter Wriston said in 1969 that um, money is a form of information. Okay, and that's what it is in essence is. And in payments, if between you and me, if I can send you a WhatsApp message for free, technically I can send you a payment message for free, right? And the only reason payment still costs a lot of money to transact is because there's regulation, and there is security concerns and all of that. So otherwise, payment is just a form of information. Now, the thing about AI in finance, and this is something that I've told in the second last chapter in my book, or no, sorry, 3 chapters to the end of the book. I said that if the product doesn't change, nothing changes. And this is me speaking to the banking industry, right, and saying to them that, guys, you talk about innovation and disruption and creation of new realities in finance. Just get this into your head. If the product doesn't change, nothing changes. And I tell the story of Kodak, and I've said this 1,000 times. I first told the story of Kodak in 2017, and I keep using it. Kodak invented um, um, Kodak invented the digital camera in 1995 together with a few players, right? And um, 2001 or 2000 or 2001, Sony came up with the Cybershot. 2007, the iPhone was born, and 2010, Kodak went into liquidation, right? And why? Because they didn't make the transition into digital fast enough. They loved their 35 physical product. So now coming back to the point that we started this conversation with, which is a deposit business, I, for one, see that the banking industry might actually embrace stable coin as a new form of deposits in the future. Okay, so I see that that the deposit business will transition from savings product to a utility product in the digital space, and the best utility token in the digital space is a stable coin. And imagine a world where every bank issues a stable coin, and the value of the stable coin is the utilization that it can have in the digital world. So banks compete on the number of application developers, open source coding, that sort of thing that takes place in a stable coin technology. So this is the kind of thinking that I'm introducing to the banks and saying, start thinking about it this way. The other thing that AI does is that there have been some first iteration of disruption in banking, such as peer-to-peer players, for example, and the peer-to-peer players, the P2P players, SoFi in the US, and then there are others in the UK and other parts of the world. They started with the promise that peer-to-peer means that you don't need intermediation, that you match the borrower and the lender of money, and it doesn't go onto your balance sheet, and you are just a platform, and therefore you disintermediate the banking industry. But what ended up happening is all of the biggest, Prosper, all of them turned out to become banks eventually. In other words, they lost the game, right? They lost the plot. And why did they lose the plot? because they use the same language as the banks. They thought that they were facilitating mortgages, and they were thought they were facilitating investments, same products as traditional banking. So once again, if the product doesn't change, nothing changes. Now, what AI is going to do is going to put so much more insights into the relationships that are created between borrower and lender, that they will start imagining new products. So a 30-year mortgage will start looking like a 3-year lease, a 2-year timeshare, another 2 years of maybe timeshares that you can hive off and ask your friends to carry, something like that. Okay, so you can actually deconstruct what a traditional lending product looks like with more data. Now the idea exists. How it becomes possible remains to be seen, but that's what I see is very likely to happen.
So, keeping on the topic of change and innovation, something that when I travel, like I'm always very interested. I always ask locals, I'm always asking people like just how things work in their economy. Cause I feel like sometimes as Justin and I are in the US, like we're just so used to how the US does things with houses, with everything, with banking, with investing. And I always like learn new things. I'm like, wow, that's really interesting. And something that you talk about is how like that was a really interesting point you made. Dysfunctional economies are actually going to be shaping the future of global finance. Could you kind of explain that a little bit more? Because
Yeah, so we all look forward to what regulators are thinking and what they're saying in terms of what they're going to allow banks to do and financial players to do and all that. And so when we think about the future of finance, we think that we are looking for guidance from regulators. But when I look at the history of finance, this innovation only ever happens in times of extreme disruption. Yeah, the most recent extreme disruption was when the U.S. couldn't hold the price of money against the price of gold, and it said, you know what, we're not ever going to do this. We're going to throw it. Sorry, what Nixon said was, it's a temporary measure. We will come back to pegging the dollar against the price of gold, and the U.S. never went back. In fact, it started an incredible revolution, causing all countries in the world to float their currencies, to make it, subject to make currencies subject to supply and demand in the global market, to trade, and so on, and no longer against the price of gold. So that was an incredible disruption, and it actually destroyed a few countries in the process, and then it strengthened certain countries which figured out how to liberalize their currencies and still have enough reserves to be able to ward off speculators and so on. And the story of financial innovation in the US is just one crisis after the next. From the day that the U.S. was formed to raise money to fight the War of Independence, and then the Civil War, and then the 1990s crisis, and the 1900s early crisis, especially in the formative years of the large businesses and so on. It was just always one crisis after the next. And then when I think about all these things that I'm talking about the future of finance, when will the breakthroughs come? And the breakthroughs come when a country just gives up the existing order. The thing I point out is that the most dysfunctional country today in finance, and then we look around and say Venezuela, Zimbabwe, these are the places, El Salvador. These are the places where cryptocurrency seems to be thriving because it provides alternative remittance, platform and so on. But the most dysfunctional country that will come out of desperation to introduce stable coins will be the United States. And I have to construct, these dysfunctional in what way? So right now, we see the regulators competing with each other in the U.S. The SEC, the CFTC, the OCC, the regulators in Chicago, all just juxtaposing against each other to figure out how to regulate all the new technologies that are coming on stream. So you think that there is purpose being created. So something else I say is this, that the way the dollar became a global reserve currency was not through purpose. It wasn't the Treasury Secretary waving a policy paper and saying, okay, this is the policy we're going to implement to make the dollar a global reserve currency. It just became a reserve currency accidentally, without purpose. The Treasury secretaries didn't bother about the money that was circulating outside the US. In fact, it was important that the dollar that circulated outside the US never comes back to the US, because you can't handle a claim when 70% today of the dollar actually circulates outside the US, right? So, and that's how it became a global trading currency. And then today, the U.S. regulators, especially the New York Department of Finance, weaponizes its ability to monitor every transaction, every dollar transaction that is cleared through American banks. Okay, so how we tell the story of how money became international, and the international financial order that we have today, is a story of dysfunctionality. It's not a story of purpose and design. Okay, so then when we think about what will create the next financial order, we look for points of dysfunctionality that we need to we need to understand. Okay, so the point of dysfunctionality of the United States today is that the total debt of the state is now $31 trillion, and the GDP of the US is I think now is $21 trillion. Right, so the ability of the U.S. to meet its obligations is now a moot point, and it's not going back. So I'm saying that debt becomes the economy. These are phrases that I put in so that people understand the points that I'm making. When I say debt becomes the economy, means that balancing the budget is a moot point. It doesn't matter if you can balance the budget. It's more important that that investors are interested in buying your debt. As the country creates more debt, internationalizing the debt becomes very important, and the best way to internationalize it is to digitize it. So it's not just the dollar that's going out there or treasury bonds, but a digital currency that is readily available in the global market. And so I see that the U.S. will just from one policy to contain some of the problems it has, it will embrace the new technologies as they become available. So when I follow the iterations of the SEC, for example, on crypto, I'm not interested in very specific stuff. I'm just interested in the trend, whether it's heading in the direction that I think it is. And so far my dysfunctionality trend idea hasn't been broken yet. So I have no reason to think that that the US will be so purposeful that it will be able to design a new financial structure. So there are elements where it operates almost as if it's purposeful. So like Janet Yellen comes up with white working papers on the introduction of central bank digital currencies. And for me, that's entertainment. Like no, this is not going anywhere. It's like, I mean, it's a case of a regulator being out of touch with the essence of the country, and that's, I can say that for a number of countries. So this is how I think. I look for what are the driving factors that creates policy or creates new realities, and then see every development against these ideas, whether they negate what I'm thinking or not. There's no need to follow, like wake up in the morning and say Gary Gensler said this, or the Barr said something else. That's all entertainment. The industry will evolve the way it always has.
One question that I had that's a little less kind of technology focused, and it goes back to some of the things you were talking about earlier, where like used to you could just deposit money and you could earn, it was a good investment just having it sit there and getting your interest. And now today, like you don't really get hardly anything from a typical savings account. But we've started to see a shift where like, okay, now we're getting back up into a high yield savings account paying 5.5% interest. And I think we all got lulled into this kind of false sense of security around borrowing money at mortgages in the 2% range. But my dad, tells me stories of a mortgage at 15, 16% back in like the 80s. So like where we are today, now that we're kind of at this like 5 to 7% range, do you see that as like a transitory thing and we're going to go back low? Do these like crazy historic lows? Do you think we're going back up to the teens? Do you think we're kind of going to stay where we are? Like from a macro sense, where do you think we are in this kind of interest ride that we're on?
That's a story of inflation and the understanding of central banks on inflation and the role of central banks themselves. I think the media has lulled us into assuming there is a sense of incredible intelligence in central banking that we cannot question, and that is so not true anymore. In fact, when I meet different governors around the world, and and I've had years of following how they make decisions and so on. Central bankers are not as smart as we imagine them to be, whether it's the US or any one of them. And in fact, they have this incredible, herd mentality about everything that they do. Why? In fact, the other day, a former vice, Roger Ferguson, wrote a paper in one of the think tanks in New York, in DC. Must be the Foreign Relations Council or one of the think tanks in DC, and he being a vice chairman, and I know him personally, him being a vice chairman, having been a vice chairman of the Federal Reserve banking system, wrote a paper saying, how did the 2% margin for inflation targeting come about? It was a wild idea by the New Zealand regulator, and I know this story, and I was very curious that a former central banker wrote that into a paper. That it was just a wild idea, and then every central bank in the world picked on that, and they keep their margins to 2%. It's almost like the central banker writing his own job description and his own KPI, right? The current Fed chairman said the same thing. He's like, I want to keep it within 2%. But if you ask any economist why 2%, there is no logic. It seems like the right thing to do. And in that way, because they define their jobs in such that in itself is dysfunctional manner, they are not ever going to solve the problem of inflation. Now whether rates will go up or down depends on a number of other factors such as capital markets, trade, and how much amount of liquidity in the marketplace. Now, something that ordinary Americans don't realize is that the government actually makes money whichever way. So the interest rate goes up, the Fed makes money, and it actually declares its profit and pays its profit back into the treasury, from the profits that it generates from higher interest rates. If it is lower interest rates, the treasury makes money and keeps the money for itself because it's paying a lower interest rate on a treasury bond that was issued earlier. So it's an interesting system that when you understand how it works, it it is not necessarily designed to solve some of these problems definitively. And the problems come from a variety of sources, like the price of commodities. When there's a war, prices go up, and then inflation gets imported, stuff like that. Now, will the rates go down eventually? My own guess is no. And the reason is that it's not just the US, but any number of large countries, Japan, China, the EU, they're all issuing more debt into the marketplace. And therefore, they need central banks that can print more money to buy that debt. So the liquidity is increasing dramatically. And just this dysfunctionality itself creates the appetite for new asset classes that can absorb this inflation. And that's how cryptocurrency was born. The early days of cryptocurrency was benign, but as inflation went up, crypto became a token by which we absorb that inflation. In fact, as I said, it's the dysfunctionality that creates the innovations in finance.
Well, Emmanuel, you are a man of many things. You're a man of much knowledge when it comes to banking. My brain has been working this episode, just trying to keep up, and you have just answered all the questions that Justin and I had in stride. But we are nearing the end of our time here, so I want to give listeners a place, a website. I know you have the book. Where do you want people to follow up if they're interested in what you're talking about today?
Cody, actually, the easiest is my own blog page, which is emmanueldaniel.com. I have everything in there, meaning the book, the table of contents of that, and also some of these ideas that I've been talking to you about. I've been loading them up onto the blog, and then from the blog, you go to where my various businesses are, the Asian Banker and so on. So my personal blog is the best place, and it's my name, emmanueldaniel.com.
Emmanuel, thank you so much for giving us some time and coming on the show and sharing some of this knowledge with us, and also just allowing us to kind of pepper you with questions from all angles, and like Cody said, just answer them in stride. So I appreciate that.
Thanks, Justin. Thanks, guys. Thank you for structuring the conversation in the way you did, because it helped me carry the ideas that I had in a clear manner. Thank you very much for that.